We are getting on. It is happening. We're live. What's up? We are live the week before I go to Kauai, head out this Friday. I could be more excited, but I am here. Will this go on in Hawaii? Will it happen? To be determined. We will see. We'll see. I want to start today by putting out there, what's the most recent investment you made? I'm just curious in the chat. What was it? Was it a rental, a flip, a note? It could be any type of investment. I'm just curious. What's the most recent investment that you've made? I've actually done a couple recent things. We do a ton of hard money lending, and it's one of the things as I look back at 2023 and I think about, what were some of the surprises? I've bought the least amount of real estate I've ever bought in any given year. I think we've had 6-7 houses this year, which is a very, very low number for us. And it wasn't, there were opportunities, but debt rates changing made it harder and harder to make sense of deals. When mortgages were 3%, it's really, really easy to go out and find a 6.5 or 7% cap rate property. I did a ton of that. I was buying 8 caps actually out in Huntsville when I started there. And so debt rates on the investment side went for me from 3.5%. Some of that was shorter term stuff. From 3.5% to 8.5%, it made it really, really hard to look at the same deal, a deal I would have bought before. So debt rates matter, right? It doesn't affect your cap rate. I'm just giving a representation of a cash return as opposed to, a levered. So I'm just, that changed a lot. So, but in the other surprise though, was I did the best loans I've ever done, right? As rates went up, it created a much larger opportunity in lending. And so I've done the best loans I've ever done. Hard money, short-term, 6 to 12-month loans. If you're looking for a great investment, I would highly, highly say that is the place that I love to park my money. Of all the investments we make out there, from commercial, multifamily, single family, even long-term debt, which I love, short-term debt is absolutely where I place the overwhelming amount of my money. And it's a couple reasons, right? At number one, highest yield. Today, you're going to get your money if you're lending it out. It's easy to get 12 to 16% as you're looking at interest rates you can charge with the points and the fees included. And so it's really hard for me to go place another investment that, again, I'm putting the money into something in my backyard, something that I know better than anyone else out there. And when you do that, it just puts you in a completely unfair advantage. And so I love parking money and think of it like you're betting on, they're going to pay you as agreed, but if they don't, you've got the opportunity to get a rental property at such a lower value, and you're lending money against stuff you believe in and stuff because it's in your market. So I am today, our sponsor today, I don't know if you say that quote, is Fluid Stance. I was being targeted on Facebook with this surfboard for your office. I've always had a standing desk. So the reason I'm a little wobbly, I'm on the Fluid Stance. I'll probably get off here in a minute. But Cole, you can actually, you can go 360. 360, that was almost 720. I don't know, it might have been, well, Cole, and you just throw the whole, that really worked out well. I'll show, I can get the idea. This is the Fluid Stance board. I don't know if this will last 24 more hours or the next 5 years of my life. It's really impossible to say, Cole. It's just things like this where it's either it's going to be the next week and a half, or it's something I'll probably do forever. So I don't know. If you'd have told me 4 years ago, Cole, I was going to be getting a cold plunge every day at 39 degrees, I also would have said you're a liar and you'd have been wrong. So, all right, I got a couple things I want to talk about today. And I saw this article, and I'll try to find out the source of the article later, but the article was about the 20 most common investment mistakes, all in kind of one chart. And so I agreed with some of them. I didn't agree with others. And I thought it'd be interesting to walk through these and see kind of what do we agree with, what do we not. And I'm going to present one second here. I'll get my slides up. And right there we are. And one sec. Cool. So 20 most common investing mistakes. First one, right? Expecting too much. Having a reasonable rate of return expectation helps investors keep a long-term view without reacting emotionally. So I think, these are the mistakes that people make, right? Expecting too much. I hear all the time someone go out, Brett, I don't think you understand this investment. I can make 25% rate of return on my investment. And when you think about the risk that you take on trying to get 25%, that risk would be astronomical. Like Warren Buffett, one of the greatest investors of our time, his target goal was 20%, right? When I make 20% of my money, I'm so excited. So when I see an outsized return at 26 or 30%, especially if it's passive, right? Remember, there's two types of investing. You got active investing where you're going to go out and you're going to put in your work, and your work is going to also be enhance the return, versus passive where you're parking your money with someone else. They're doing all the work. And so you're completely passive in that. And the return you don't have to do anything for that time from a time standpoint. So when you see the higher the return from a passive standpoint, it's not realistic. So the investors expect way too much. One way I think about my money, I break it into 3 buckets, right? So if I've got 100% of my investable dollars, I'm going to put 40% of it in very safe investments. And in a normal market, I would say yielding 4 to 5%. I'm going to take the next 40% and I'm going to go up to a little stronger returns. I'm going to want somewhere between that 7 to 10%, right? I'm going to take a little more risk, but I want really stable returns. For a long time, I was doing this in real estate. Then I'm going to take 20% of my money and I'm going to put it in my moonshot, right? And so my hard money lending is still going to fall into that safe, steady return, even though the return's a little higher. And then my moonshot fund, I expect to either crush it and get returns that might be 50%, 100%, but I'm also realizing I might lose the entire investment. I'm making, these are my, this is, you're going to be a good flyer. This is going to be the flyer that I'm going to put in my portfolio that it's either going to, I'm going to invest 100,000. It's either going to come back at 10 or 20 million or it's going to come back at 0. I was with a buddy the other day and I saw a guy that bought Bitcoin. I'd never seen this before, bought 700 Bitcoin, Cole, back in like 2011. So back then, if these Bitcoin, it would have been, what was it? 670, like $7 a coin back then. You think about it, Cole, it's so crazy. I mean, can you, and still kept it. By the way, back then it was cool. Did you know this? Because a younger guy.
It was nearly $30. $30 whole dollars.
No, it was $7 and he bought 700 of them. So it was like, he spent like $5,000. It was $5,000. But today it's like 28 million. The point of the story was back then it was paper. You know, you always think like encrypted, it's digital, it's in your digital wallet. Back then it was actual paper. Your passwords and all that was in paper. It was just crazy to think. I've heard a few stories like that where someone had it and actually didn't know that BTC was Bitcoin. Crazy, but it's another example. That's my moonshot type money. By the way, my wife, amazing story. My wife had this genius idea that when crypto.com bought the naming rights to the Staples Center. When they did this, when they bought the naming rights, everyone was going to sit in the stadium. They were going to use their phone, and they were going to all go start creating on crypto.com. So these coins were going to skyrocket, and we were going to make all the money in the world. And my wife's not super involved in our investing philosophy. However, she made a great argument, and we decided to invest $75,000. Which these coins were trading for like 32 cents or whatever it was. So, I mean, I have hundreds of thousands of these coins. And exactly what you think would happen. The next 3 weeks, it skyrockets. We turned like $70,000, a true story, into probably its peak, it was $230,000. And I immediately thought, this is a scam. We should sell it all, sell out. My wife says, babe, this is the one. This is a moonshot. Just let it go. Let it go. 75,000 might turn into 75 million. We play our cards right. No, that did not happen today. Let's see if I can get I don't even care. I'll even show my account. Let's see if I can get this, Cole. No, don't talk down to me like I'm not in the crypto space, Cole. I'm going to get this. Oh man, can I log into my existence? This would be so amazing if I could pull this off. So I'm going to try to do this while I'm telling the story.
And on a fluid stance.
And on a fluid. It's just a lot going on today. I do want to, I'll find it for the next one. But anyway, in this account, I haven't looked recently. Last time I looked, $9,000. We managed to take 75, 230. Now we're hovering at that. But think of the tax losses, Cole. You think of how it's hard to get a loss. I mean, you can't just give someone $1 to save 40 cents. So expecting too much. If you expect too much, we may not get to all 20 today, Cole. That's possible.
That was number one.
So we knocked that out. Investing too much. Second biggest mistake, there's no investment goals. I could not agree with this more. One of the things we talk about in the seminars and the training that I have is, number one, you need to forecast where you want to be with your money at some distant point in the future. Think out 30 years from now was the time frame I used. I went out, I set a goal from a net worth standpoint, 30 years from now, where do I want to be? And then I'm going to go line up the assets and where do I need to be next January? Where do I need to be January of 2025 so that I know that I'm on track to hit my target 30 years from now? I have the fundamental belief that human beings did not miss their goals because they didn't set goals or have great intentions. I believe they missed them because there was no check-in point from the goal to the outcome, right? If I want to go lose 35 pounds next year, if I have a daily awareness, I can figure out how many steps I have, how many calories I have. If I can figure out different health measures, I can check in and know very early on, am I on or off track? Because what do I know about my goal? Right? I know that some point between now and 12 months from now, I am going to get off track. However, daily awareness allows me to get back on track. It's no different with your financial situation. The problem there is you go 30 years out into the future and you've actually got no one, you've actually missed it and you can't unwind the 30 years. You can't go back. So number one, you don't have investment goals. You're not breaking it down in what's your 40, 40, 20. How are you thinking about your money, right? So you're focused on the short-term returns, the latest investment craze, instead of long-term investment goals, right? When everyone went crazy in crypto, the reason outside of my lovely, lovely wife that we didn't do it is I didn't understand it. I don't have an outsized advantage, right? And I believe in real estate in any market, you can be the expert in your backyard. And even if you're buying in similar market shares or around you, you can use that knowledge to get outsized returns. So we're having this conversation. I see my guy Jack's back here, Carter Group, Chicago. All right, cool. Back in here. Not diversifying, right? Diversifying prevents a single stock from drastically impacting the value of your portfolio. This is probably where I disagree. I understand the principles of diversification. I understand all the ideas that, don't put the old saying, don't put all your eggs in one basket. I'm very much, in my mentor, who's Gary Keller, is very much it's okay to have all your eggs in one basket. You just have to really, really watch the basket. And so I would overwhelmingly, probably 95% plus of my entire net worth, everything I own is in real estate. Now I'm diversified inside of real estate from I've got things in lending, I've got some commercial exposure, I've got multifamily, I've got single family, right? I've got the different asset classes there. But from is it all real estate? Yes. And if you look, I saw a really interesting statistic recently that over any period in time, Cole, there's never been a time in history that rents went down more than 3% over a 3-year period. Think about it, there's never been a time in history to where rents didn't decline more than 3% over a 36-month period. So what does that mean? Over time, when you own rental property, you're always going to get a 3% increase or more, right, over that period of time minimum. Usually our leases, we build in 5% annually, and that is our target rate to increase our rents. So remember, every year that rental property, my cap rate improves. If I've either paid cash or locked in long-term debt, every year my cash flow on that property will improve and improve and improve and gets better and better and better. So not diversifying, but I would say put it all in one basket, really watch the basket. Next big mistake, number 4, focusing on the short term. It's easier to focus on the short term, but this can prevent investors from second guessing their original strategy. Right? If you think about the short term in real estate, the one truth that has been true forever is if you held real estate for any 50-year period, it made a lot of money. The people that their intention is to hold it indefinitely, those are all the wealthiest people you see. I recently just joined this really, really group of high-end networking group called Tiger 21, and it was my second meeting. I love it. And it's, you think about the horizon. We're talking a lot about how long are you thinking out into the future? And if you separate as investors, what are we really doing? We're just pricing in risk, right? Less risk, I'm going to take a lower return. Higher risk, I get a higher return. And so just if you can focus on a much, much longer horizon, if you look at any groups like that, when you study what the really, really wealthy did, more often than not, you'll find that they bought a ton of real estate and they just held it indefinitely. Just bought it, kept it, the right location, the hard corner, the main street that goes onto the freeway. Main will be valuable 20 years from now. It'll be way more valuable 20 years after that, and it'll continue to be more and more valuable. So the longer the term you make your bet, the easier it is to not have to deal with the ups and downs and the swings of the market. All right, number 5, Cole, buy high and sell low. Investor behavior during market swings often hinders overall performance. Look, I get it. Everyone wants to buy high. We all think we're going to. Everybody we all want to, buy high and sell low. That is the myth, right? We all want to do that, though. We want to hit the top, sell, hey, how can we sell right here? Then we don't rebuy. We want to buy at the very, very bottom. We want to have all those tricks. And here, the reality is you're never going to hit the very, very peak, and you can avoid the very, very bottom. So as it's going up, that last 20%, you're going to probably give up something. If you're selling, when you're buying, you never know that there's not one more dip there. And again, it goes back to number 4, which is if you have a longer term horizon, absolutely, it takes a lot of this out of it, where you don't have to worry about market cycles. In most markets, the real estate market forever had been one of those things at the high point, and then it would be the next high point would be 14 years apart, right? That had been the case forever until COVID, and we're quite a bit past that now. So, with the stimulus of COVID and those things, if you say the last peak was, we call it 06, 07, so 14 years later would have been 2021. That hasn't happened, right? So we're way past that time frame. So we should add a down in between there. So it'll be interesting to see that we're what, 2 year, so we'll be 4 or 5 years longer in the cycle. So as we're going through this, I'd love to hear any thoughts you have, if you agree or disagree with any of the points. Throw them in the chat. Let me know. Do you think, is this, which one of these myths, or what are the most common mistakes? Which one of these hits you, or do you agree or disagree with it? Here's a good one: trading too much. That applies, I would even say, in real estate as much as they're really talking about stocks here because of fees, right? Things dip, but I traded, and they show if you miss, like in the stock market, if you miss like the highest 5 days of the year that stock had the most gains, and you didn't invest in those, it's almost impossible you'd make money. So all of it, and it's the whole idea of you got to have your money in all the time. You can't time the market. It's just how much time can you keep it in the market. So trading too much, same thing on the real estate side. I mean, we've got tools to mitigate some of those tax things from a 1031 exchange perspective. But if you're selling real estate, it's expensive to buy and sell real estate. You've got fees, and it costs probably some in the range of 6 to 9% actually every time you sell a home, in terms of title fees, insurance, commissions, all those things. And so the more you trade that out, it's just less. And as the numbers go up, it's just a bigger and bigger number that can affect your overall returns. So number 7, paying too much in fees. Fees can meaningfully impact your overall investment performance. I kind of talked about fees in the last example, even though it related to just being trading. But, I think about, if you're trading often, you're probably missing time in the market. If you had something great, why not just keep that thing, hold it, and go buy something else? I've got some real estate in my portfolio that I bought for a period of time where I was waiting for it to rise or hit certain numbers, and we're selling some of that stuff now. And it's not that I don't believe in it, it's just I bought it for a specific reason. If I took a deal in Huntsville, Alabama, I bought a lot of homes for $50,000. This was in 2016, and now they're worth between $150,000 and $200,000. And they did what they needed to do. The rents were really, really good, and they've climbed a lot. But now I'd rather shift those dollars into something that's a little more quieter. Maybe trade 10 or 20 of those houses for a commercial building out in Phoenix or wherever. But so I think that as you're trading too much, or the fees matter when you do that. All right, next thing, focusing too much on taxes. I actually, this is one where I kind of disagree a little bit. Taxes matter a lot, so I think you should definitely factor that in. In other words, if there were two investment, types, and one was taxed and one was not, we would all pick the one that, hey, we're not going to pay tax on. Conversely, if we were going to pick investments that we knew were going to have higher rates of return, those would be more valuable in our Roth retirement account. Why wouldn't I want to self-direct to get that and not pay tax those dollars coming in? And I absolutely love our custodian we use. We've been using them forever, and they really helped us understand the power behind a self-directed Roth and putting that as, figure out how you've got to do it. I know we've got some high income earners that watch what we do, but there's a backdoor Roth. There's a way for you to put a ton of money in there. So if you look at the difference over investing $500,000 or $1 million, and if you look 30 years down the road at an 8% return, let's do it, Cole. Let's figure out what that would be. I'm going to do it here. I'm going to switch screens. This is going to be a huge move, Cole. This is going to be, where am I? Is this real?
Oh boy.
No, wrong one, but real close. Hold on. Watch this. Yup.
Boom.
Wow, Cole, you were.
Boom.
So look, let's do a 30-year period of time, and let's say we were going to invest $1 million. We're not going to, and yeah, we'll just do two. We're going to contribute $10,000 a month, and we're going to get an 8% return. Nothing crazy. All right. So now, would you rather, Cole? Question here: would you rather have 25 million? You've got $25 million in one of these accounts. You're going to pay 0 tax, and the other one we're going to assume is all in long-term gains. You take it out and pay it. You pay $5 million. I mean, would you rather pay $5 million in tax? Cool, sure. or would you rather not? And all of that was a choice around the entity structure and where you placed an investment that had the highest chance of a yield over a long period of time. So I try to find the investments that I can make that have the lowest risk with the highest possible returns inside of my Roth account to prove that. Now we did 8% return. Let's play around with the numbers. What happens if it's 10%? 42 million. Look at that. What? That's what I said, Cole. Exactly. And so 25 million to 42, 28, 42. Now I would say in hard money, it's very easy for an average 12%. Now you're at 70 million, 28, 42, 70. Nothing changed here. We took $1 million. We're putting away 10 grand a month over a 30-year period of time. There's not a person watching this today that actually plugged in, you figured out real estate, you understood how to find deals. You didn't have any money, but you figured out how to find deals and contract those and sell those contracts, which is absolutely you can do. There's not a person watching this that couldn't make $10,000 extra dollars per month. And so I bring that up to say, then the only variable we're playing with is what's the rate of return we're going to get. Right now, you could take zero risk. You can get treasury bills right around 5.5. I mean, it might be lower, closer to 5. Let's see what that is. Oh, don't worry about that, Cole. You got to go this way. But look, let's just say under the worst possible scenario today, I could put this amount of money in treasury bills. I had $1 million. I'm putting away $10,000 per month. I'm getting 5.5%, which is a guaranteed return, provided the federal government's in business. And if they're not, then we got a whole different other host of problems. And so right there, 20% of that, that's close to $3 million. So would you rather pay the $3 million in tax or not? And again, so if you go back, this is one of my amazing tech skills, just one of the fastest screen switchers in the business right there. And so if you focus only on tax, they're saying you shouldn't focus on it. I think you should. I don't think it should drive your investment, but I think the tax matters. And as an example right now, as we're filming this, what people don't realize is bonus depreciation changed from 100% to 80%. And if you're in real estate and you can depreciate the property, all property depreciates. Normally in residential, it's over 27.5 years. In commercial, it's over 39.5 years. And there is a strategy called a cost segregation, to where you can essentially break apart the depreciation. And the easy way to think about it is you can take the depreciation sooner. So instead of it depreciating equally over 27.5 years, I'm going to take a lot of it up front, and then I'm going to get a smaller amount over the next 27.5 years. Now, why does that matter? Well, certain properties depreciate differently. As an example, again, as we're filming this right now, a car wash. A car wash, so much of the property is what they call 15-year property when they do the depreciation. And so the shorter the property length, so much of it's in that shorter time frame that falls under this 80% bonus depreciation. And so as an example, if I bought a $2 million car wash, and we'll assume that 80% of the purchase price was the building itself, and 20% of the purchase price was the land. And so I've got a $400,000 land basis, and I've got a $1.6 million building basis. And so I could basically do to bonus depreciation, going to do some quick math here, 80% of the 1.6 million. So 1.6, 0, $1.2 million. So that 1.28. So $1,280,000. So if I had made $1.28 million this year in earned income, meaning I did something, sold something, my company netted that, and I qualified as a professional real estate investor. It's a certain part of the tax code that allows you to take this amount of passive losses known as depreciation. If I made 1.2 million and I bought that building, the building's still going to probably pay me a 6% cap rate. I pay no tax. I don't pay any tax on the 1.28 million. So focusing on an investment, in this case, buying the car wash as opposed to a bunch of houses, could be the difference in paying the government 40% in taxes. Why does that matter? Your return is radically different. So it's not, I would agree that you should focus on taxes. Uh-oh, and we've got questions in the chat. All right, hold on, let me get there. What is your, all right, we've got the first question coming in from Instagram. What is your split between real estate and non-real estate investment like stocks? Great question. Zero. I have $0 in the stock market today. I have 100% of my investments are in real estate, lending, whether that's debt, multifamily, commercial, single family, anything, even deeded natural gas royalties. So all those things I invest in. And so I don't believe in the stock market. Not to say it's not a great thing over the long period of time. If you want to bet the total market index or something like that, totally. There are great arguments that if you want to set it and forget it and a 6 to 8% return and your horizon is 30 years, buying I think it's the Vanguard total market index is a great idea. My challenge in individual stock picking is I know that I don't know anything about it, and I don't want to do the research. I don't want to see how many cars Tesla's rolling off the lot, and if I believe the analysts are going to, meet their expectations or not, or what's going on in China, how that affects their overall supply chain. I don't want to figure out those kinds of things because I'm just not that smart. I would rather buy 123 Main Street, rent it for $2,000 a month, and that's just a simple math I can do that has worked out really well. And
Well, not initially, though.
that's where I go.
You don't have the money to buy one, two, Main Street.
If I didn't have the money to go buy 123 Main Street, I'd work for someone and I would go sell properties like 123 Main Street. And I would sell lots and lots of those. And then I would go make offers to buy. I'd find out exactly what the people that were buying the properties, what they wanted, and I would go find it. And then if I could buy it at a lower price, I would sell them those contracts. I would wholesale contracts out until I had hundreds of thousands of dollars. And then at that point,
You never invest until you could buy real estate.
I would not invest until I could buy real estate. I would just wait because anything in that would be a distraction. I'd put in treasury bills and get 5% until I had enough. Or unless I had an unfair advantage. In other words, if I'm a dentist and I'm watching this and our equipment leasing company charges us 9% interest on the equipment, would I say, well, it's a really great bet to invest in my own equipment so that now I can make 8% and I know I'm going to have that machine? That's a totally different conversation. But bet where you have an unfair advantage. I believe real estate is the best place to play. Why? There's been all the wealthy people hold all their money outside of private equity in real estate. And so I don't claim to be the smartest person out there, but I do believe I can model and follow really smart people. So my split would be 100% zero. I'm a real estate guy through and through. All right. Looking for more multifamily every day here in Chicago, finding supporting patient. Yeah, it's hard. It's you got to look for deals. Off market, there are deals. I'm seeing some interesting things in the office market. People are now trying to figure out, right? We've got office space that's not coming back. What can we use that for, right? You've seen now they're trying to turn office into multifamily. I think that's hard. I've got a friend here locally who's doing that. They're buying office with the intention of turning into apartments and refitting the building. And the argument being you can buy office so cheap today because buildings are vacant and people want to sell them that you could spend the money to model it out, put in the plumbing, and now you've got an apartment complex inside of that office building. I think more likely the recent thing I saw was office to medical. That made sense to me. I could see how you could transform an office and turn it into some kind of like urgent care type. I can possibly see that. But yeah, we're looking for multifamily here in Phoenix. So yeah, I would love to see maybe what are you seeing from an ROI target? Are you seeing everything big multifamily over 50 units is a 5 to 6 cap? I'm curious. 50% up front. My guy Dorich.
He's talking about cost seg.
I've never paid for a cost seg up front.
You get from the tax company? Is that what you're saying?
So yeah, you would get in that example. I would get well, if you're going back to the taxes. So I use the example if I bought a $2 million car wash that had a building basis of 1.6 million, 80% of that was 1.28 million. So on the 1.28 million, the highest federal tax bracket's 37%, plus whatever your state is. Arizona's got a super awesome tax where, over a certain amount, the more successful you are, the more you keep paying. It's super, super cool. But 37% would be federal, right? So but it would tier off on our rates are progressive. So you got kind of the 12, 32, 35, all that. So let's just run it at, we'll blend it at 35. 0. So yeah, you're talking about saving roughly between $400,000 and $450,000 in taxes. And I mean, that's significant. I mean, it's a massive amount of money. And I mean, if you go back, Cole, why does it matter? Why do taxes matter so much? If I go factor in the fact I can take $448,000 that I would have otherwise had no option but to pay to the federal government, and I can put that back into a real estate investment, what is that return over the next 30 years? And it's totally insane. So we got one more question here. I wonder if I'm going to say this name right. But I'm going to go for it anyway. That's Janae. It's final answer. Give me a thumbs up, Janae, if I nailed that. I feel strong, but is it? You can just say yes, no on my pronunciation. I hope I nailed it. So when is the break even on spending for a cost segregation? Really good question. I'll actually drop. I have a company I absolutely love, U.S. Tax Advisor Group. I'll drop a link in. I've been using them forever. So two different options, right? So number one, if it's over a certain dollar figure, in my mind, that's probably $1 million. If you have $1 million more building, you probably want an on-site cost seg study because they might see things by going out there to find more depreciation. Those are more expensive. Then you've got the just kind of online modeling version where they get a bunch of that data and then do it, and those are less. I think they charge something around $700. Maybe Cole can click and see if there's something we do. They do for us. I think they do. I think they knock something off for our group, $50 or something, something like that. Cole's gonna check the numbers maybe and tell me a price, but it's somewhere in that $600 to $800 range. And so for me, even if I'm buying a $60,000 house and up, I look at it because I can kind of now I know where they come in. But I've found for sure anything over 100,000, provided you're you qualify as a professional real estate investor, I think it's totally worth doing. I do it every single year. So I love these guys. Joe, the owner, Joe Barrett, good friend of mine, good dude.
How far back would you go for cost seg?
You can go back 3 years. So you could take any property you bought in the last 3 years. You have to amend your returns, but if you could if you had 5 properties and you spent whatever that is, $3,000, whatever the number is, and it got you $150,000 back, which depending on how many properties you bought, that'd be real. I think it makes a ton of sense. We've had so many people in our mastermind group, our Be Wealthy Mastermind or our KW Wealth Mastermind, who have gone back and have seen the checks for $200,000 or $300,000 or $400,000 in money coming back to them from the government. So
what year is it right off to when you do it?
That
year, or is it?
So you get the credit. So it goes back. So you're going to get, you could go like, let's say if you hadn't, so you'd file 2023. So you get this year, you go 2022, 2021, and depending how you filed, maybe 2020, right? The way the 3-year filing could work. So, you might be able to go back to 2020 taxes, which would be the year 2019, right? So you can get back there pretty far. But you could, before they do it, all good companies should give you a proposal and show you if it makes sense. So there's no obligation to do it. And if you bought a house anytime after it's like October of 2018, that's when bonus depreciation comes in and where you get the most value from it. But if you bought one house, you're in the real estate business, you'd qualify. I mean, you can qualify as a professional real estate investor. If you can, it would be crazy to not do it. I mean, it's tens of thousands of dollars in a tax refund that you'll get. And I've seen so many checks. It's not shocking anymore when someone at our events like, hey, I just got $80,000 back. I didn't even know about this. The other one that we should talk about is actually 45L. And so a lot of people got rental properties. I never knew this until about 3 years ago. And Joe with U.S. Tax Advisor Groups taught me this, which was there are energy credits. If you are improving a property over like the 1987 energy efficiency rating, like the average of, it's right around that era. If you're improving the property by over 50% more efficient than it was in like 1987, the government has certain credits. And so if you have AC units and you put in LED lighting, in a lot of cases that would be enough where you get a $2,000 credit. It's called 45L. You can go look it up. You can look at right on the IRS website, 45L tax credits. There's commercial, there's residential. So both those are there. So you can go and absolutely check that out. It's if you're in the rental property business, it's not long before you're going to have to replace an AC. First year I did it, and they're credits, so dollar for dollar, up to $2,000. I think I got like a $35,000 credit for the things I was already doing. So definitely go look at the credits. And I'm going to jump back in here.
One more.
Oh, sorry, I have one more. Janae, did I nail it? We'll never know. We'll never know if I nailed her name. Does 45L count when doing a fix and clip? Mike, it does. That is another insanely shocking one. Yes, so if you're putting in a brand new AC unit and likely on a flip, I bet in almost all cases you're putting in new light bulbs. You're either real close, and if you're not, you could do a hot water. I mean, you're right there, but 100% it applies to fix and flips. That's where the bulk of ours come. After we did all of our rental properties, but we still get quite a few of those as we're upgrading the AC units because a lot of the stuff I own is that 1970 to 1990 where AC units are going out right now. So 100% it does count. You could do your 4 to 5 Ls. They do them actually with U.S. Tax Advisor Group. So the same people that do cost segregation studies, they also do Our 45Ls. So reach out, and definitely you could go back. We actually had to drive out to some of ours and take pictures of the AC units because we'd already sold the properties, but we had them in. We figured it all out. So we had to get warranty numbers. We had receipts. We needed the serial numbers. Unbelievable, Cole, what you have to do in the tax game to save $1. But that was a very interesting call I had to make. Hey, man, would you mind driving around to these properties and taking pictures of the serial numbers and bring them back? It's just an easy game. I jumped ahead. Number 9, not reviewing regularly. You've got to track. I mean, if you don't track your net worth every single month, you're not in the game. And that was said that aggressive to me in front of a crowd of people by, my coach, mentor, and friend, Gary Keller. Brett, are you tracking your net worth every single month? And I said, no. I'm doing it the months I like to. I'm doing it the months that I want to, and the months that I know I crushed it. Absolutely. I'm in a 100%, I got my net worth nailed. The months that I know went down, no, I wasn't tracking it. And he just made the point, you're never going to be wealthy. You are absolutely not going to be wealthy. And this is in front of a group. So, not the softest way to say it, but he's 100% right. If you do not have frequent check-ins, you have to know where you want to be. You got to know where you are right now, and you can look, where do I want to be next January of 2025 so that I can know if I'm there, I'm on the right track to get what I wanted in 30 years. And so the reason I track my net worth every single month, I'm gauging. And then because I'm a crazy person, and I'm fit for a straitjacket, I want to figure out how far ahead in the future can I get? Can I get out in 2029? Can I get that far out there? Or can I get to 2030 and start living ahead so I can reset the goal or go bigger and do more to take care of the people and the causes I care about? So that's what I focus on. I really believe that the regular check-in monthly, quarterly, annually, and knowing that distant target is what makes it all work. Yes, there's other benefits of rebalancing, like over time you might choose to reposition your real estate. One of the things when I sell, I'm trying to take a house, I'm trying to take a house, make it the next biggest asset class and make it less noisy and try to create less risk if I can. Right? The houses I'm selling, I'm trying to get into commercial buildings that are on 7-year triple net leases, hopefully with a higher depreciation, like from a car wash. That's a real world example of things I'm trying to find right now. And so again, but reviewing it regularly allows me to make the decision, hey, this property is not performing as well in my portfolio today. There's a better way I can get higher returns on that capital doing something else. Reviewing it regularly allows me to see that in real time. All right, this is the biggest one. You can't even see it, and that's how bad it is. We blended that in just to make the point. I don't even know if the whole internet's even going to catch that, but it's misunderstanding risk, right? That is, in my opinion, what is the biggest mistake? Number 1, misunderstanding risk. Everything you do in investing has risk. All we're doing is pricing it. In other words, if someone's buying $1 million building and they're going to put $950,000 down and you're going to give them a $50,000 loan. So if they didn't pay you any money, you would get $1 million building for foreclosure costs and a $50,000 investment. How much risk is there in that transaction? I would argue, in my opinion, if that happens, you're going to need guns and ammo. You don't need a note on a building. And so that's supposed to be a hilarious joke. The point is, for $50,000, I would argue that's almost no risk. In other words, if we get to that point, the world's on fire, it's a zombie apocalypse, and you're going to hope you're like in the movie Waterworld and you're out in the middle of the ocean. Outside of that, it's terrible. And so for 50 grand, so I would view that's no risk. Now, is that likely going to come with less return, right? The other side of risk is return. So in that scenario, would I do a loan in Phoenix, Arizona today at 7 or 8% right now? 100% I would do that loan. You might say, why? Normally you lend at 12 or 14% in hard money. Well, why would I do that? Because I view treasury bills as zero risk, and I can get between 5 and 5.5 to have the money sit in treasury bills. I view this real estate deal on a $50,000 note on $1 million house is more risk than guaranteed, but not a lot more. So if I could go from 5.5 to 8.5, I would trade those 3% more for slightly more risk, right? So if you don't understand that a 28% return is going to come at an exponentially higher risk, right? There are people today, if you're willing to do 100% loan on a house, same building, $1 million building, if you're loaning them $1 million, right? You could probably charge whatever the usury laws are in your state, 18% and 5 points, and some dumbass will pay it. Of course they will, because you don't need anything. It's limitless risk to the lender. In that scenario, well, the return has to be 20 or 30% with points and fees, because I'm likely to lose, right? They're going to pay 3 months, tear the thing apart, leave, and never pay you. Exactly. So the risk is priced into that. They're going to charge, they've got to get 40%, right? If I'm lending credit cards to people I know are never going to pay me back, or a high percentage aren't, I've got to make sure I charge a truckload of interest to the people that are going to pay me back, because I'm just going to lose all the other ones. So if you don't understand risk and the difference between your lower risk, your middle risk, and then your moonshot, how do you know how to allocate your capital? And again, are you thinking about it 40% of your money, 40 and 20? If you don't understand risk, you're just making all the bets the same. And I think when you're gambling because your neighbor says, oh my God, did you hear that crypto.com is going to $1 billion? It's bullshit, right? Unless you know everything about crypto.com, it's not going to happen. Right? Your neighbor, a lot of the time, your neighbor's peddling shit and they're selling you an idea and it's just shit. And so you're like, oh my God, they're buying shit. I got to buy shit. So we both can invest in it because it's cool. That's not an investment thesis. It's just not. And so that was a Charlie Munger quote, rant, by the way. He said that people want to get in that if their neighbor was selling shit and they're buying it and they were like, oh my God, I can't believe it. He goes, people will start actually buying it because they believe what their neighbor says. Charlie Munger, by the past, we lost one of our greats. Lost a couple of gangsters, Sam Zell, Charlie Munger in the last like 60 days, I think. And Munger, I got some an article, one of his best talks. I got it printed to go to Kauai, which let me see if I can grab it. Actually, Cole. Hold on there. This is the part where we don't plan.
The audio.
We don't plan. Don't worry about that, Cole. It is The Psychology of Human Misjudgment, one of the talks. Oh boy, I've got a. Let's see if I can go full. This is just so much going on here. The Psychology of Human Misjudgment. Charlie Munger. It's one of his talks about all of the misjudgments, and it kind of ties out to our conversation here. Now, if I don't put that back in my backpack, that would be terrible. Side note, just got the greatest backpack ever. I've been on a gear thing, Cole, and the nomadic backpack is. I used to carry a Toomey bag, and I got this nomadic backpack.
New sponsor.
Yep, guys, if they're watching, I can't imagine how much gear they're going to send us. The nomadic backpack though is awesome. I bought one to just like for an overnighter, and I actually love the overnight bag so much that I was like, I'm going to trade out my really crazy Toomey bag that I've had for a decade. And the nomadic backpack is completely insane. So in addition to just wealth knowledge, Cole, you also get a little just latest hack. You know, what's out there? What are the kids doing? Side note, this Nate, my new comedian, Nate. It's like Bergazzi, or I don't know how to say his last name, so forget about it. But my guy Nate has this great bit where he goes, buckle up. He goes, all right. He goes, and he's 43, we're the same age. And he goes, when you're around like a 20-year-old guy, like I go to you, Cole. Cole, you're how old?
24.
I go, man, us young guys, we gotta stick together. And then 20 minutes later, I see some guy that's 45. And I'm like, dude, get away, old man. Get the hell out of here, old timer. And that's how it really is. Anyway, got to go watch Nate. I don't know that links back to risk, Cole. I don't know how we're going to get. That's just a risky comment. That's all it is. Hello. Little trade out. You got.
Your girl got back to you. You got the name right.
Gosh, I knew it on the name.
Jamie.
It's way more real than I first heard. Thank you. Assuming company's taking a percent. Yeah, Janae, there are people in the cost seg game. Not everyone is a trustee steward like U.S. Tax Advisors Group, our friends. It does suck. They take a percent, which is just kind of, I don't even understand on a commercial basis, right? The whole idea came out of commercial, and that was the design. It started there. And I found a way, the hardest part of finding someone is so many of those companies don't do residential like it, or they charge so much. I've seen companies charge $5,000 and $8,000 per report, which then it's really hard to have it make sense. And basically they're charging you a percent, kind of to Janae's point. Did you have anything else here, Cole, or was there more questions?
You go.
Gosh, okay. We may not get, Cole, what if we have to have next week
during Christmas.
Next week during Christmas, what? And that is what day is that? God, the day after Christmas, Santa does Kauai. Oh, could you imagine? I'll probably have a hat post. What would be, what? React to the media. This is huge, right? What's the mistake they make? They're going to go, they heard that Tesla is being shut down, so I'm going to short Tesla, or they just got the new government contract, I'm going to buy it. Here's the thing. If you've heard it or are even thinking it, the markets are extremely forward-looking, right? All of everything you know about that is always priced into the current stock price. They've already figured that out. They already know exactly what that would have, what the thing you're thinking about, if it happened, what that would do to the price. Now, where you win in a stock market is you have to bet against what everyone believes, and you have to be right. Right? If you look at the example of the subprime crisis, right? Everyone believed mortgages were safe securities. There's nothing that could go wrong, but they started bundling crappier and crappier mortgages and sold the crap D quality, bond. They basically sold those as A quality, right? So they got all this crap now with all the good stuff, and everybody quit paying. And so the Big Short, Michael Lewis, awesome book, awesome movie. So The Big Short, the whole thing was that Dr. Stephen Burry bet that it was crap, and a certain percentage of default would take down the entire real estate market, take down the entire mortgage business. So he bet extremely aggressive against it, right? So, but everyone believed that mortgages were safe. Like he had to create his own category to short it. People thought he was insane, like it's a joke, like no one would bet this. So that's how you win in that game. And so if you're reacting to it, there are other people that are focused either on totally different things. They already know that. They know things you don't, or they're focused on a much longer period of time that way. All right, forgetting about inflation, right? Historically, inflation has averaged 4%, right? So we know where it's at. We're 5.2, I think core, maybe 5.1 core CPI just came down. We can get a fact check. We'll throw that in the chat. Chat, is that real? That's what all the kids are saying right now. So all the kids are saying, my son is going, as a creator, you create. Chat, is that real? Cole, just going to love that. Going to go tell all his friends about. I'm just dropping these modern gems. Us young guys, we got to stick together. So forget about inflation, right? So today, 5.1, we got up to, what did we get? Did we get to 8 or 9? What was our high point? I think we got to 8. We'll just go guess, and then you look it up. What was the highest point of inflation in COVID, if you do that? I'm going to go 8.2. Did we get to 9?
Looks like in 2022, we were at 8.5.
Okay. Was it the highest? Is that this?
Pull my graphs.
Okay, well, and that it's fact, right? And that's the problem about taking stuff from the media. That's the problem. We go back to reacting to the media. We don't know that Cole knows what he's talking about, right? It could have been 38%. Now it's like 8.5%, so 8.5%. All right, so you forget about inflation, right? Why does that matter? If inflation's at 8.5%, it's going to be if your returns are 4%, inflation alone is eating away your buying power. In other words, if you were able to buy Cole coffees, as an example, a question that Cole you want to solve for is how many coffees do you get in the future? And our internal team's going to love it. I mean, how many coffees is it? So today, your amount of money to buy 1 cup of coffee. In the future, what if it only buys a little thimble of coffee for a very small amount? That'd be a crappy world. I mean, you got 1 cup of coffee, now you got almost no coffee. Conversely, Cole, you want to be the guy in the future who's got lots and lots of coffee. Moral of the story.
This is good. The third time.
Thank you. Trying to time the market, right? It's just time in the market. You cannot time the market. So there are better times, right? Is the office market right now a market that's a little bit of a dumpster fire? Yeah, right. Buildings are empty. People want to come back to work in some cities and states. If you were to require your staff to come in 5 days a week to your office, that would be a crazy idea, and you'd be smashed. And I'm sure we'll get some lovely comments in the chat about that. But I'm if we offered an in-work position, I want someone to come in to work for that. I know that's a crazy concept, but so the office market, because people can't go back to their offices, is rough today, right? It is a crazy time. So today, if you got a way to repurpose it, if you're buying those offices for what they built them for replacement cost, is there an opportunity if you could make it medical or whatever? Is it possible, Cole? We don't know.
WeWork space. But
that's an example, right? So the argument, if you're trying to time it, yeah, today's better to buy an office than it was, pre-COVID. Yeah, there's a play. I think I would rather focus, instead of timing it, focus on location, right? If you buy the right location, Maine and Maine, and you just close your eyes and wake up 20 years from now, I think 99 times out of 100, Cole, those numbers are radically different, and it's higher in 20 years. Not doing due diligence is probably one of life's biggest problems, right? Get referrals. I mean, from the investment standpoint, are we going through every possible scenario, whether it's a home inspection, a feasibility study, some type of environmental test, or the investment side? Are we doing all the things for due diligence? On the people side of things, right? Do we have a referral for this advisor? Can we see the results? Do we know people that have been with them for 5 to 10 years and are happy with their product or service? I mean, do you have those kinds of relationships? So there's different things, broker check, and there's online reviews. But I think if you have lots of people you like and respect that have used someone for an extended period of time, I like that. I think on the investment side, every possible due diligence that is customary, right? If it's a septic system, make sure you're getting a septic inspection. Yes, can you waive these things? I, for a long time, believe that investing in due diligence is a way to improve your returns, right? So when it costs me due diligence in more research, I've killed more deals because of that, and I believe it gets me higher returns because we are extremely thorough when we buy debt. We underwrite for our own houses, right? Due diligence is every part of it because that's an investment, right? So we want to, if there is a possible inspection, when we're buying properties, we're going to look at the age of the AC unit and price that into our decision. I mean, if I know that this AC unit's 25 years old, even though it's perfectly cool today, do I believe it's possible in the next 5 years I'm going to replace the AC unit? I do believe that's true. And so from all those major mechanical items, hot water heater, we're looking at the age of the electrical, the plumbing, all those things that are just going to be big ticket items. Roof, right? Roof's a huge one. A lot of the properties I'm buying, 1970, 90, those roofs are 30 to 50 years old, and I'm likely to have to replace it. Again, it's just a part of my formula that if I know the day I buy it, I've got an AC unit and a roof, and I know it's 30 grand, it should affect my buying decision. That should come out in due diligence. All right, working with the wrong advisor. I got to tell you, I buy property, even in Arizona, that I'm licensed and could do myself, and I use a real estate agent. When I buy a property up in Pine Top, Arizona, I use a real estate agent. It's not because my license doesn't work, but up there, you're considered what they call in the business a flatlander. And if you write an offer up there, it's very hard to get business done. So I'll use a local who knows them country ways of making it happen out there. And I can do that impression, and that's not going to get me canceled because I am a redneck and I'm proud of it. Everyone I know where I'm from is a redneck, and I too am a redneck, so I can do that joke, Cole. That is just, and yeehaw, Cole. Now that is completely disrespectful because you're not a redneck. And that is how you get canceled, with that type of nonsense. That type of just outright hate for people, Cole. That's what's going to keep you down. All right, you're talking to the wrong advisors. So I would definitely tell you, in all things, the wrong advisor is a problem. The right one makes the difference. Think about the time that you used a true expert, not the person who's just doing it, but was an absolute pro, whether it's an attorney, some of the insurance world, a banker, right? Excellence, I find, is slightly more expensive and pays 5 times more. And so I always go with the best and get an advisor. Investing with, and then a giant blank. And that's going to be a tough one. Thank goodness I have the article. Investing with emotions. I don't know how I would have got emotion. Oh, there's emotions. That's emotions, Cole. Investing with emotions, which is a person or a rock, emotionally charged, to just push that up the hill. Sometimes our internal team absolutely crushes the visual, but like every champion, I can make it rain from anywhere. And so when you invest in emotion, although it can be challenging, remember to stay rational during market fluctuations. Best example I could give you, crypto. When crypto, I'll be honest, I was pretty emotional when crypto.com went from $230,000 to $9,000 in a matter of days, hours, really, when you think about it. It's 230, 110. How long did that? Wow, that was a quick hour. So good. So that was emotional. And I love my wife, my lady friend. She's a lucky girl. But financial advisor, no. Great mom, lovely wife, nails it, crushes it every time. Oh boy. So hopefully she's in the chat. If she's watching this, that would be hilarious. She doesn't. Okay. Chasing, here we go, 18. Let me just kind of figure that out. Chasing yield. That's what the right answer is. Chasing yield, and I would have known that by the giant black image on the right-hand side. Just that's what yield looks like. It's like staring into the abyss, looking back. It's how exciting it is. And so, yeah, if you're chasing yield, not everything's going to be dividend paying. As an example of chasing yield would be hard money lending, right? So if someone's buying something for $300,000, I can probably get today in Arizona, if I'm willing to lend someone with 10% down, so $270,000 against something they're buying for $300,000, I could probably charge 16% interest today. I'm chasing the yield. So if I had choices, if I said, hey, I'll give you a 16% yield with 10% down, you get a 12% yield with 20% down, and you can get a 10% yield with 30% down. Which one of those would you pick? So I'm asking the audience, play along at home. Would you rather have 16% on your money with 10% down, 14% on your money with 20% down, or 10% on your money with 30% down? My answer would be, I want 30% down and 10%. Why? I want to reduce the risk. And the fundamental idea in borrowers as you lend to others is the more skin in the game, the more capital the borrower puts down, the greater the likelihood they're going to pay. And it's just proven time and time again. Ask me how I know, because I've lent people different down payments. I've done as high as 95% or 90%, which is stupid. And I've done it because they had a really, really good deal. And if they didn't pay me, I at least got an awesome piece of collateral. But dumb from a risk perspective, you didn't understand, hey, I'm lending someone to get that piece of collateral. We got two more, Cole, so I really have to fly through these. Neglecting to start. Some people never, it reminds me of my favorite joke that I have, which is you've got to do the thing. Well, in life, there's no substitute for actually doing the thing. Now, doing the thing is the most important thing in your business, thing that drives it. If you're in sales, it's going to be calls or door knocks or contacts, right? Some form of that. If you're in the dental cleaning business, it's probably how many asses sat in your chair in that period, in that day, right? It's going to be a good indicator, okay? So if you never start, I had a really great joke. I was going to land that, Cole, and I got so excited about building up for my joke for you. God, where's that going, Cole? Baby back. Now I got to get there.
Looking to start, do the thing.
Oh, doing the thing. God, it was so long. So doing the thing. You've got to actually do the thing. That was the dental hygienist. The thing was how many chairs and how much plaque did you blast off? So doing the thing, talking about the thing. That's not doing it. Reading a video, watching something, reading a book. Don't touch that one. If you tell people to read books, and if you say that Audible is not reading, people will tell you, they will light you on fire. They will blow you up in the chat. Well, I'm going to say it now to the world. Audible isn't reading. It's not. Reading with a book is reading. Listening is listening. Reading is reading. No, I'm not telling. No, I'm not against blind people. That's what someone said in a previous post, that I was anti-blind. I'm not. I'm just saying that reading with Braille, reading. And so I want to go on the record and set the record straight. Neglecting to start. So we got to get going. We got to do the thing that you cannot wait. Best time to plant a tree 20 years ago, second best time today. But you've got to start. I will tell you, young people today, the opportunity is if you start investing in your 20s, it will make all the difference. Time is one of your weapons, right? Rates of return, amount of money you put in, amount of money you started with. There's only 4 variables. Time being one, right? The earlier you do it and the more money you put away, the rate of return matters, but not as much as time. Time is the biggest factor. So one of the things I do for my kids, right? They've got a self-directed retirement account with Horizon Trust. Our friends, our sponsors, Horizon Trust. Love those guys, but my kids have a self-directed retirement account, right? Why? If I start at 7 years old, I've done this math before. Let's see if we can close out with this, Cole. Watch. You are going to have your mind just shattered, Cole. I don't know if you're at a place to have your mind shattered. I don't know if everyone, guys, get ready. Let's imagine you're 7 years old. What? And you're going to go to 67. And I did this for my kids. I started when my youngest was 7 years old. And I put $6,000 in a Roth retirement account. And so he had $0. And let's say that through lending or whatever, I'm able to get him an 8% return over 60 years. How much money is that? Cole, what's your guess?
God, so much.
So much. Great guess. It's $717,000. Okay, 8% return. Oh, no, I'm sorry. That's incorrect. He's going to continue to do a Roth every single year, so another 500. My bad. It's $10 million. I was like, what? That's impossible. It's almost $10 million. Your child, if you started doing a Roth account for them and they contributed, again, once they turned 18 and they did this for themselves, they'd have $10 million. Well, what if they get a 12% return? $72 million, right? You could put your kids in a position to have a radically different thing. So mom and dad, if you're watching this and they're not on the Intetranet, but if they were, this would have made it easier. So I'm not saying there's mistakes. I'm not saying we should go back in time, but
parents aren't terrible people.
You're not bad people. I love you both dearly. I think I have Christmas after my mom's here in a minute. But You're not bad people, but $72 million would have given me that. It would have taken out that tough spot, Cole, between 0 and 72. It just knocks that off the picture. But, all right, that is the place where you want to think of it. So time is your weapon. And then if you go to 87, it just gets, kaboom. It doesn't even make sense. Almost $1 billion, Cole. All right, let me go back for our final top 20 investing mistakes. Oh, there's so much clicking. It's hard. Is not controlling what you can control, right? You can't predict the market. You can't predict what it'll do. You can control time. You cannot always control return. You can your time and what you put in. And so obviously the more money you invest earlier, the better it will be. I thought it was interesting to talk through it. I'd love to hear your thoughts in the comments. If we've got a few questions, got to go right there. Boom. I've got a question. It is what due diligence you do for your flips or hard money? Is it the same? Totally different. So on a flip, we are going to, number one, run part of our due diligence, right? We're going to run basic comps. So doing the math of where's the market at today? How much competition will I face when I go to sell it? What's the average months of supply in that area? We'll look at that to make sure, that particular area today is not out of imbalance with the market. It'll be the normal time to sell. We're going to look at the competition. What do they have to spend, right? How does our property, is our construction budget have to go up or down to hit a certain price point? We're going to look at size and how do we compare to all those things. We do a home inspection, septic inspection if needed. I don't like to brag, but we flip a lot of mobiles. Don't judge me for that. Don't think I'm bougie. So that would be a standard flip, right? Economics, and then we're going to get to actual property information, safety, structure, mechanical issues. On the hard money side, right, we're going to look 99% at the asset, right? If I know the borrower personally or the friend of a friend or referral, or they have a track record of doing lots of deals, that's helpful, but 99% of my evaluation is going to be on the property. So I'm going to lend at today's market 30%. I believe we've got the lowest rates out there, but we're one of the more conservative lenders. We want 30% down. So if someone puts 30% down, we would look at that loan. And now it's got to hit our box. We would want them to be buying it for less than what it's actually worth. So we're going to target what is the as-is value. So if someone's buying something for $300,000 on an investment side, there's got to be some reason they're buying. So hopefully it's worth $330,000 or $350,000. I would love to loan that person $210,000. That's a safe investment for me. I can help someone where they could use my capital. They could go do more deals. And it's worked out really well. So on that side, it's going to be, we do pull credit. The reason we want to pull credit is we want to see if you're not paying your current mortgage, the likelihood you might not pay me. And so, or you're not paying your car, I might be the next one. Doesn't mean I wouldn't lend the money. I just may need more collateral or more down payment to do that loan. So a little different, but really all asset-based lending on the hard money side. My guy chat, keep the main thing the main thing. We should drop in, Cole, the do the thing post. I don't know if you can find it. I don't know if chat, is that real? I don't know if that can happen that quick. But if you've got any last questions, throw those in there. We went way over an hour, Cole, with the thousands and tens of thousands of people watching, both at home and at their local theater where we're streaming live.
Thank you, Fluid Stance.
Thank you, Fluid Stance, for the surfboard. I don't know. I feel this is going to be a 2-week, Cole, on the Fluid Stance, but can you really do that? No, you can't. All right, Cole, we're going to wrap. It's a wrap.
Last live stream 2023.
Last live stream, possibly. You decide.